Can you consistently beat the stock market by investing in stocks that grow their dividends? The short answer is a lot of times, yep, if they're top-tier companies. I'm joined now by Sam Stovall, Managing Director of U.S. Equity Strategy for S&P Global Market Intelligence. Sam, so good to see you once again.
Thank you, Rhonda. Good to be here.
You've done a lot of research into investors that use dividends as a way to try to outperform the market, and especially with volatility, we've seen a lot of people like that. Generally speaking, is it a smart move to move into dividend stocks?
Well, yes. Actually, I would expand that by saying moving into higher quality companies. We define quality as being consistency of raising earnings and dividends in each of the last 10 years. And based on that consistency, S&P applies a letter grade to a company. A minus, A plus are above average companies, B plus are average, and then B minus, C are below average. And usually when the market performance gets challenging, the high quality companies tend to outperform the low quality ones.
So you actually have a phrase called Dividend Aristocrats, and that's kind of the cream of the crop. Tell me how a company becomes a dividend aristocrat and what investing in them can do for your portfolio.
Well, a dividend aristocrat, you will just have to meet one criteria. That is, you have to have been able to increase your dividends in each of the last 25 years. And right now, there are about 60 companies in the S&P 500 that have done that. A lot of them are your household names. And by investing in them over the long haul, an individual has done quite well. Since 1999, while the cumulative total return for the S&P 500 was about 80%, the cumulative total return for the 500 dividend aristocrats was about 340%. Of course, there's no guarantee this kind of performance will repeat, but what it really implies is that because these companies exhibit lower volatility, the less you lose on the way down, the less you have to make up when the market finally recovers.
And Sam, what's interesting about that, I guess, is does it really matter what sector these dividend aristocrats are in?
Not really, and you'd probably be surprised. You would most likely think, oh, well, they're probably in the utilities space, but actually no. You have many that are in the consumer staples, food, beverage, tobacco, healthcare, industrials, financials, so they're pretty well spread out amongst the S&P 500's 10 sectors, so a well-diversified portfolio at that.
Can we call them bulletproof?
No, nothing is bulletproof. In 2008, while the S&P 500 fell 37%, dividend aristocrats also fell, but by substantially less. They posted a total return decline of 22%.
So almost all the time, it's worth investing in.
Well, in the last 7 years, the dividend aristocrats have beaten the S&P 500 4 times and have come within 0.5% in 3 additional years. So pretty good track record, in my opinion.
Sam Stovall, great to see you once again from S&P.
Good to talk to you again, Rhonda.
I'm Rhonda Schaffler for The Street.